The stock market is like a loaded spring. The higher it climbs, the more tension builds. And right now, it's up 63% in 2 years. Sounds incredible, and it is. But here's what most investors miss. This exact scenario has played out 4 times in the last 40 years. 3 of those times, investors who ignored a specific signal got hammered with corrections ranging from 20% to 34%. One time, those who understood the pattern rode the wave for 4 more years and gained over another 100%. And this signal can add or remove tension from the spring depending on its direction. The signal has nothing to do with earnings reports, nothing to do with PE ratios, nothing to do with what the Fed says in press conferences. It's simpler than any of those, and it's more reliable. And this matters because once you see this pattern, you'll understand what separates the prepared from the panicked. I'll reveal the signal in a moment, but first, August 1987. Financial magazines had smiling traders on their covers. Portfolio statements looked incredible. Then October hit. The market dropped over 30% in 100 days. But here's what almost nobody talks about. There was a signal flashing red for months. Flashing while the S&P 500 surged 71% from August 1985 to August 1987. Flashing while investors celebrated a 44% gain in the first 7 months of 1987. Jump forward to 1996. The dot-com bubble was building momentum. The S&P 500 gained 65% over 1995 and 1996. This was part of a larger rally that would eventually deliver over 400% gains between 1990 and 2000. But here's where things get interesting. Unlike 1987, no correction followed 1996. The market didn't just stabilize, it kept climbing, hard. From 1996 to 2000, stocks gained another 100% plus. So, same scenario, massive 2-year rally, but completely opposite outcomes. 2011 rolls around. The market had recovered from the 2008 financial crisis. Stocks surged almost 60% from March 2009 through August 2011. It felt like the worst was behind us. The economy was stabilizing. Then the correction hit. The European financial crisis compounded things, and stocks pulled back sharply, over 30% in 3 months. 2021. The pandemic recovery rally was historic. In roughly 2 years, the market gained about 60%. It looked unstoppable. Then 2022 arrived, and the S&P 500 entered a full bear market, eventually dropping over 30% from its highs. And here we are, 2025. The S&P 500 is up 63% over the last 2 years. So the question becomes, is this another 1987, 2011, 2021? Or are we looking at 1996 all over again? The difference comes down to one number most investors completely ignore during rallies. And here's the crazy part. It's hiding in plain sight. Inflation. But not just whether inflation is high or low. What matters is the direction it moves during the rally. That's the signal the pros watch while retail investors are busy celebrating gains. Think of inflation as pressure on the spring. Each tick higher increases tension. A tick lower decreases it. Watch what happened to inflation during each rally. 1987. Inflation started at a low of 1.1% in 1986, but by October 1987, right before the crash, it hit 4.34%, a 3.24 percentage point spike in roughly 18 months. The market crashed weeks later. And here's what makes this pattern so reliable. 2011. Inflation sat at 1.1% in November 2010. 1 year later, it had climbed to 3.4%, a 2.3 percentage point jump. Shortly after, the correction hit. And we've got one more. 2021. The most dramatic example. Inflation bottomed at 0.1% in May 2020. By the end of 2021, it hit 7.04%. It kept climbing, eventually peaking at 9.1% in 2022. The bear market followed almost immediately. The spring released, 3 out of 3 times, same pattern. Now watch what happened in 1996. Inflation was 3.3% in 1996, and by the following year had decreased by about 50%, and it kept declining for 2 more years. The market? It kept climbing until 1999. Here's what you want to understand. When the market surges around 60% in 2 years and inflation moves significantly higher, corrections follow. When the market rallies but inflation stays stable or declines, the climb can continue for years. That's not luck. That's a mechanism, and here's why it works. Higher inflation leads the Federal Reserve to raise interest rates. Borrowing costs for companies increase, business investment slows. At the same time, bonds begin looking more attractive than stocks. Money begins rotating out of equities and into bonds. All of that pressure builds until the spring releases. But when inflation stays low during a rally, those forces don't materialize. The Fed doesn't need to slam the brakes. Borrowing stays cheap, money keeps flowing into stocks. The party continues. And this matters because these forces can combine to bring unsustainable tension to the spring. When inflation jumps during a market rally, it creates a chain reaction. The Fed raises rates, companies' costs increase. Not only does money get more expensive, but materials and input costs also increase. Companies try to pass those costs on to consumers, but consumers are already stretched from rising prices. So demand weakens. Corporate earnings get squeezed, stock valuations start looking expensive relative to bonds, and investors begin rotating out of equities. The spring doesn't break, but it releases. That's what happened in 1987, in 2011, and in 2021. But in 1996, that chain never formed. Inflation declined. The Fed didn't need to raise rates. In fact, rates dropped from 6% in January 1995 to 5.25% a year later. Money got cheaper. The rally continued. So what's happening right now? And here's the part most people will overlook. Inflation, 2.4% last September and at 3% a year later. That's a 0.6-point jump, not nothing, but nowhere near the spikes that triggered past crashes. But it is a 25% annual increase and a full point above the Fed's inflation target. So the spring is loading. The question is, how fast? And this next data point could mean the rally still has runway. This may surprise some people. The Cleveland Fed tracks rent prices for new tenants. That data shows rent inflation actually decreasing for the first time since the 2008 financial crisis. Why does rent matter? Because it's one of the biggest chunks of the consumer price index. When rent inflation falls, overall inflation typically follows about 9 months later. This is what institutions track obsessively. The crowd never does. So yes, the market has surged 63% in 2 years, but the second part of the pattern hasn't triggered. Inflation hasn't surged like it did before corrections in 1987, 2011, and 2021. The spring is loading, but not by too much. Does that mean we're in the clear? Not exactly. Here's the part that should make people nervous. The reason inflation is staying relatively low isn't because the economy is strong. It's because of less hiring, more layoffs, and reduced business activity due in part to the uncertainty around US tariff policy. And speaking of tariff policy, many experts believe we haven't seen the full effect of tariffs on prices yet. Also, personal savings rates are low. Debt burdens are high. Consumer sentiment is hovering near levels we saw during the 2008 financial crisis. 30% of Americans are living paycheck to paycheck. Meanwhile, corporate profit margins are at all-time highs, 13.3% of GDP. Money that can rotate back into financial assets, pushing them higher. This is a wealth inequality dynamic, not a healthy economy. But as long as inflation stays suppressed, financial assets can keep rising. That's a big but. Inflation has been stubborn and rising somewhat. And here's what should make you pay attention over the next 6 months. In addition to many economists warning we haven't seen tariffs' full effects yet, the Fed is now lowering rates. Twice in the latter half of this year. That throws another variable into the mix. Lower rates often feed higher inflation. On the other hand, new tenant rent prices suggest inflation may ease in the near term. But here's what you need to understand. The correction signal requires both parts of the pattern: rapid market gains plus accelerating inflation. Right now, we have the first part. We don't have the second yet. That's what the insiders watch and what the crowd doesn't. So let's talk about what to watch. Think of this as a three-phase pattern. Phase 1. The rally. The market surges 60% or more in 2 years. This is the setup. We're in this phase right now. The S&P is up 63% over 2 years. Phase 2. The divergence. This is where paths split and what you want to watch. Either inflation accelerates, or it stays stable or declines. Right now, inflation is at 3%. We have early signs of moderation in key components like rent, but we also have potential upward pressure from tariffs and lower interest rates. Phase 3. The outcome. If Phase 2 shows accelerating inflation, corrections have historically followed within 6 to 12 months. If inflation stays flat or declines, the rally can continue for years. We're in Phase 1 with warning signs in Phase 2. The next 6 to 9 months will tell us which path we're on. This isn't about predicting crashes, it's about understanding the cycle. Most investors celebrate the 60% gain and completely ignore what's building underneath. They watch stock prices climb and assume the trend will continue. Then they get blindsided when corrections hit. But you're not most investors now, you're on the inside. Insiders watch inflation during the rally. The crowd only celebrates the gains. Insiders position early, the crowd reacts late. Once you understand this pattern, you won't panic when others do. You'll see the setup forming. You'll know what signals to track. You'll understand when the rally has room to run and when risk is building. This matters because the conditions are forming now. The market correction isn't cancelled, it's conditional. And the condition is simpler than most people realize. The crash isn't cancelled, it's cued. And the signal that tells you when it's coming is hiding in plain sight. Now you're watching what Wall Street watches. If you found this valuable, hit subscribe. We publish fresh content several times a week to help you understand the economy and protect and grow your wealth. And keep the momentum going. Watch why the stock market hasn't crashed yet, what they don't want you to know. It's on the screen. If you want to get your financial house in order, I've put some links in the description that may help. Check them out. Thanks for watching. See you on the next one.